You walk into a property, see gleaming hardwood floors and fresh paint. Imagine cash flowing like clockwork every single month, and then reality hits you like a freight train when 3 units sit empty for 90 days straight. Suddenly, that pro forma you built in your spreadsheet looks about as reliable as a weather forecast from a fortune cookie. And you're wondering if you just bought yourself a very expensive paperweight with a mortgage attached. Here's what we're unpacking today: the cold, hard truth about vacancy rates in stabilizing markets. Why your optimistic 10% assumption might be setting you up for financial whiplash, and exactly how to calculate what's realistic versus what's wishful thinking. We're going beyond the fluff and into the nitty-gritty of occupancy psychology, market timing, and the gap between what brokers promise and what bank statements deliver. Let's start with the elephant in the room. Stabilizing markets are neither booming nor crashing, which means they're doing that awkward thing where everyone's waiting to see who blinks first. In these markets, vacancy isn't just about empty units. It's about the collective hesitation of renters who aren't sure if they should commit, investors who aren't sure if they should buy, and sellers who aren't sure if they should list. The typical broker will tell you to budget 5 to 7% vacancy, smile reassuringly, and hand you a glossy packet that makes everything look like a sure thing. But here's the twist. That number assumes your market is humming along predictably. Your property is competitive, and you're not dealing with seasonal swings, economic uncertainty, or the fact that half your potential tenants are still deciding whether to live with their parents for another year. What actually drives vacancy in these in-between markets? First, it's affordability. Fatigue renters have been squeezed for years. And even though prices aren't skyrocketing anymore, they're not exactly rushing to sign leases when they're one emergency away from financial chaos. Second, it's competition. When sales slow down, more landlords hold properties longer, which floods the rental market and turns tenant screening into a full contact sport where you're competing on price, perks, and how quickly you respond to that 3 a.m. maintenance text. Remember 2019? When everyone thought the party would never end and vacancy rates in many metros hovered near 3%? Fast forward through a pandemic, inflation spikes, interest rate hikes, and a collective what just happened moment, and suddenly that same market is sitting at 8, 9, even 12% vacancy in some asset classes. The shift wasn't gradual, it was whiplash, and it caught a lot of investors with their spreadsheets down. The psychological toll is real. You bought in thinking you'd be the next real estate mogul, posting about passive income on social media. And now you're Googling how to evict someone at 2 in the morning while eating cereal straight from the box. Yet, here's the paradox. Some investors are still crushing it, maintaining 95% occupancy because they adjusted rents strategically, offered incentives, and didn't treat tenants like interchangeable widgets. History loves to rhyme, and real estate vacancy cycles are no exception. Every decade or so, we go through this dance where everyone panics, thinks the sky is falling, then realizes that housing is still a fundamental need, and people still need places to live. The data backs this up. Average vacancy rates across US rental markets have fluctuated between 5 and 8% over the past 30 years, spiking during recessions and dipping during booms, but always reverting to a mean that hovers around that 6 to 7% range. I'll be honest, I missed the early 2010s rental boom because I thought prices were too high, and I'd wait for a correction that took another 8 years to show up in any meaningful way. The lesson wasn't that I should have had a crystal ball, it's that waiting for perfect conditions is a losing game, and building in realistic assumptions beats trying to time the market every single time. So where do we stand now, and what's actually realistic? In a stabilizing market, one where prices have plateaued, transaction volume is moderate, and economic signals are mixed, budgeting 8 to 10% vacancy is prudent, not pessimistic. That buffer accounts for tenant turnover, market softness, seasonal dips, and the inevitable surprise of someone breaking a lease because they got a job 3 states away or decided to move in with their partner who has a golden retriever named Larry. Community wisdom from experienced landlords echoes this. Forums, meetups, and investor groups consistently report that operators who budgeted conservatively weathered the transition from boom to stabilization without breaking a sweat, while the optimists had to scramble, drop rents, or sell at a loss. Predictions for the next 12 to 18 months suggest we'll stay in this holding pattern. Not a crash, not a boom, just a steady, unglamorous grind where good operators thrive and sloppy ones get exposed. Here's the misconception we need to kill right now. High vacancy doesn't mean real estate is a bad investment. It means you need to adjust your underwriting and stop pretending you're smarter than the market. If you budget 5% vacancy and reality delivers 12%, you're not unlucky, you're underprepared. And that's a skill issue, not a market issue. Another myth. Vacancy is entirely within your control if you just add value or screen better. Wrong external factors like local employment trends, new construction, interest rates, and even gas prices influence whether people move, stay put, or double up with roommates. And no amount of granite countertops will override macroeconomic headwinds. Here's what history teaches us, distilled into action. Always underwrite conservatively, assume higher vacancy than the market average, and treat any outperformance as a bonus rather than a baseline. Encourage moderate risk by diversifying across property types or markets. So if multifamily softens, maybe your industrial or single-family holdings pick up the slack. The strategy isn't sexy, it's disciplined, unemotional, and boring as hell, but it works. Buy properties with strong fundamentals, budget for realistic vacancy, maintain healthy reserves, and don't over-leverage just because some guru on the internet said debt is good. Process beats prediction. Patience beats panic. And position sizing, never going all in on one property or market, beats conviction every time. Philosophically, here's the thing. Real estate is a long game where discipline, conservative assumptions, and consistency compound into wealth more reliably than any secret strategy or hot tip ever will. I'm comfortable with whatever the market throws at me because I've built buffers, accepted that vacancy is part of the cost of doing business, and stopped trying to be a hero. If you underwrite for 10% vacancy and only experience 6%, congratulations. You just gave yourself a margin of safety and extra cash flow to reinvest or build reserves. If you experience 12%, you're still solvent, still sleeping at night, and still in the game while others are panic selling. The bottom line is this. Stabilizing markets separate the tourists from the residents, the hopeful from the prepared, and the spreadsheet dreamers from the real deal operators who actually know their numbers. Real estate remains one of the most reliable wealth building vehicles in history, but only if you respect the fundamentals, budget for reality, and treat vacancy as a feature of the business rather than a bug in your plan. So yes, vacancy stings, it's money you're not making, units you're still maintaining, mortgages you're still paying, but it's also predictable, manageable, and ultimately just part of the rent you pay to participate in an asset class that has created generational wealth for millions. Embrace the grind, plan for the gaps, and keep moving forward because the alternative, sitting on the sidelines waiting for perfect, is the only guaranteed way to lose. And if you're serious about finding investment properties that make sense in today's market, head over to www.growthsense.com, where you can browse residential and commercial listings, connect with sellers, and even list your own investment properties for free. It's a straightforward directory built for investors who want access to real opportunities without the fluff. Because at the end of the day, execution beats hesitation every single time. Thank you for watching. And if this resonated with you, drop a comment, hit that like button, and let me know what markets you're looking at because we're all figuring this out together, one realistic vacancy assumption at a time.